It's 11:47 p.m. You're scrolling your phone, watching a guy in a rented Lamborghini explain how he turned 10 grand into $500,000. He's standing in front of a Miami penthouse he doesn't live in, but the math he's pitching feels just plausible enough to keep you watching. However, the people who actually built generational wealth this way aren't making videos about it. They're sitting in a Toyota Corolla at a Costco gas pump, often unaware they're even rich. To turn $10,000 into $500,000, your money needs to double roughly 6 times. This relies on an old finance shortcut called the Rule of 72. Divide 72 by your annual return percentage to find out exactly how many years it takes for your money to double. At an 8% return, that happens every 9 years. When we apply this to the S&P 500, which has returned about 10% nominal over the last 30 years, the timeline reveals a problem. If you drop in $10,000 and never add another cent, you won't cross that $500,000 mark until year 41. By year 41, the original goal has likely outlived your utility for it. Most people can't wait 4 decades for a single deposit to mature. Time is a powerful variable, but it requires a catalyst to actually move the needle within a human lifetime. This is where we move past the do-nothing path. There is a 3-step framework that accelerates this timeline by turning contributions into multipliers. It's called the lazy method. Step 1. Open a brokerage account at a firm like Vanguard, Fidelity, or Schwab. It takes 4 minutes on a phone. Step 2. Buy a total stock market index fund like VTI or VU. These funds charge a fee of 0.03%. For every $10,000 you have invested, you pay $3 a year, less than a single latte. In exchange, you get fractional ownership of nearly every major American company in existence. Step 3. You must automate your contributions. Set up a recurring transfer from your checking to your brokerage every payday. The system buys more of the fund automatically, regardless of the price or the news cycle. This automated framework removes the need for expert intervention. According to the SPIVA report, over a 15-year period, not a single category of professional fund managers saw a majority beat the index. A simple, automated phone app effectively outperforms a room full of PhDs. To see how this scales, look at Venus. She makes $58,000 a year as a marketing coordinator. She starts with $10,000 and automates a $400 monthly contribution into a total market fund. By year 5, she has $44,000. She's been disciplined for 60 months, yet still doesn't have enough to buy a reliable used car in cash. Most people look at this flat line of progress and decide the math simply isn't working. This is where the majority of investors quit. When that frustration sets in, people try to time a market. But missing just the 10 best days in the S&P 500 over the last 30 years cuts your total returns in half. Those best days almost always occur during or immediately after a market crash, the exact moment when everyone is convinced they should sell. Fees act as a silent drag on that recovery.
Comparing 2 identical $1 million portfolios reveals the damage. One pays the 0.03% index fee. The other pays a standard 1% management fee. Over 30 years, that single percentage point siphons off $2 million of wealth. Warren Buffett famously bet $1 million in 2008 that a low-cost index fund would beat a hand-picked group of hedge funds over a decade. The index returned 126%, while the hedge funds returned 36%. Even the most expensive experts struggle to overcome their own fees. Surviving the first 5 years requires ignoring the impulse to time the market or pay a professional to manage your discipline. If Venus holds through that initial stagnation, the numbers begin to shift. By year 9, she hits $96,000. By year 10, she crosses $112,000. In year 10, Venus contributes $4,800 of her own earnings, but the account itself generates roughly $9,000 in market gains. For the first time, the money is doing more work than the person. From here, the growth scales rapidly. By year 20, the balance reaches $311,000. By year 30, she is sitting on approximately $760,000. That massive final balance isn't the result of a lucky trade. It is the market's deferred reward for 10 years of passive discipline. Increasing a monthly contribution from $200 to $500, roughly the cost of a streaming and takeout budget, adds $447,000 to the final net worth over 30 years. At $1,000 a month, the total climbs to $1.6 million. For those starting later, the strategy remains identical.
A 45-year-old with a higher monthly cash flow of $1,000 can reach a similar retirement balance as a 25-year-old contributing $200. The math accommodates either time or capital. Ronald Read is the human embodiment of this math. He was a gas station attendant and a janitor in Vermont. When he died at age 92, he left behind an estate worth $8 million. He didn't invent anything or trade tech stocks. He bought blue-chip companies like Procter & Gamble and Johnson & Johnson, companies that made the soap and detergent he saw on shelves every day. He held them for decades and reinvested every dividend. Ronald Read outinvested the majority of hedge fund managers by substituting a high income with high patience. However, we have to look at the current environment. The Shiller-Cape ratio, which compares stock prices to long-term earnings, is currently near 40. Historical averages are closer to 17. This suggests that the next decade of market returns may be significantly lower than the last. When the next downturn occurs, the strategy remains to keep buying through the volatility. The lazy method relies on the fact that a crash is simply the moment when shares are on sale. The financial industry has a direct incentive to talk you out of this approach. There is no commission on an investor who chooses to do nothing. They profit from the noise. You profit from ignoring it. Real wealth is built by making one aggressively boring decision to automate and then refusing to be wrong for 30 years. Set it up tonight, then forget your password. Over time, the math handles the rest.